Good morning, everyone. My name is Maxwell Okello. I'm the Chief Executive of AMCHAM, and I'll be moderating this morning's webinar. Before we begin, some quick housekeeping notes. The webinar will be 1 hour long. Your audio and video will remain muted for the session. For good order, the speakers will run through their presentations and then take questions at the end. If you have any questions, please type them in the Q&A tab at the bottom of your Zoom window. I want to begin by thanking all of you for making the time to attend, and a special thank you to our good member Deloitte for partnering with us for this webinar to share their insights and expertise based on what they are doing in assisting businesses locally and globally to navigate the unique challenges faced at this time. This is the second webinar in our response to COVID-19 Thought Leadership series. The purpose of these webinars being to equip businesses or to equip business leaders with critical information and tools to enable them to make the right strategic decisions during this crisis period. Today's session will focus on tax considerations and the practical liquidity management measures that businesses should take into consideration now and into the recovery phase of what we've come to know as the New World Order. President Kenyatta last month announced a raft of policy and tax measures aimed at cushioning Kenyans and businesses from the ravages of the pandemic. That will see, 1, a reduction of personal income tax top rate from 30 to 25%, 100% tax relief for persons earning up to 24,000, reduction of resident corporate income tax rate from 30 to 25%, reduction of turnover tax rate for small businesses with less than 5 million in revenue from 3 to 1%, and a reduction of VAT rate from 16 to 14%. As business leaders, we are keen to understand what the immediate and longer term implications of this and other measures are likely to be. And so to help us unpack the various tax and regulatory changes, as well as gain insight into practical liquidity measures that businesses can take within our Kenyan context, we have with us Fred Omondi and Gladys Makumi from Deloitte, East Africa. Just a little about both. Fred Omondi is the tax and legal lead at Deloitte. He has over 16 years of experience in various aspects of taxation, including tax dispute resolution, transfer pricing, international tax issues, and he advises clients on tax issues relating to business setup and restructuring. He has assisted many organizations, both local and multinational, in managing their tax affairs. Gladys Makumi is the financial advisory lead at Deloitte. She has over 15 years of experience in advisory engagements ranging from financial due diligence, business valuations, financial modeling, and transaction advisory to post-merger advisory services. She has advised local and international organizations ranging from blue chip companies, private equity firms, and small and medium-term enterprises. And so without much further ado, I'll quickly turn this over to Fred and Gladys to take it home. Thank you.
Thank you, Maxwell.
Thank you, Maxwell. So I will start by just setting the scene in terms of the times we are living in from just a high level economic and impact perspective, and then I'll hand over to Fred to take us through the tax considerations and then come back with the practical liquidity management measures. So when we look at the global economy and what is happening, for the first time since the Great Depression, both advanced economies, emerging markets, and developing economies are in a recession. So we find that nobody has been spared from this pandemic. Everybody is struggling from an economic perspective, and to the extent that coming closer home, we find that all research firms have downgraded GDP growth. Coming closer to home, we find that the Kenyan GDP growth has now been revised to about 3.4%, depending on how long the pandemic takes. And for us to return to normal, it means that businesses will then be severely impacted. So it is expected that the cumulative loss of global GDP over 2020 to 2021 will be about 9 trillion, and this is greater than the economies of Japan and Germany combined. So it is something that's going to affect our businesses. So when we look at the industries, of course, the first people who've been really hit are the airline industry, world hotel and tourism, because really borders are closed, people are not traveling, only cargo planes are flying, and that means then the people who hotel occupancies are at a significant low, and it's estimated that there'll be about 75 million job losses globally, and a loss of about $2.1 trillion in revenue. So we find for most of these industries, the loss in revenue is permanent. So it's basically gone. There's no recovery from that. So it's about what happens next. The auto industry, again, has been impacted. When the pandemic started, especially January, February, supply chain was impacted, which means then that there's been an issue around there. We find then in the financial services industry, the level of non-performing loans is expected to go up. Lenders have to find a way to negotiate with their customers on how to better restructure the existing facilities and provide additional facilities. So we find that all industries have been impacted, some negatively, others positively. When you look at people in the personal care space, when we think of the sanitizers, the soap, when we think about personal protective equipment, when we think about the pharma industry, when we think about manufacturers of medical equipment that's required to deal with this pandemic. So we find that is happening. When we think about the consumer industry, there's a lot of unemployment that's going to happen, reduction in income, and we expect then that some goods will be discretionary, and hence some of our businesses will be impacted by this. So the top issues that have been identified for companies, and these issues span geography, industry, sectors. One is because of the travel restrictions, customers are staying at home and people are not readily available to consume your goods. The workforce disruptions, labor shortages, are your employees able to get to work? The issue of remote working and what infrastructure you have in place to enable your people to work at home. There's in the consumer industry, there's decreased consumption. Even as we look at liquidity management from a business perspective, consumers are now also looking at ways to preserve their cash. So there's decreased consumption. Now it's all about what are the essential goods. The supply chain disruptions, there are delays in when goods can come into the market. There are shortages because manufacturing is not happening as usual. Your suppliers are not getting your products to you on time. This will then, of course, then lead to us having then a decrease in our profitability, because we have the fixed costs that are not going away that we have to deal with. We have to be smart about how we're going to do it. And then we find for the lenders, the issue of covenant breaches, because all of a sudden, if I'm not generating sufficient revenue, then I'm not able to service my borrowings. And you will find there'll be waiver requests. And then how do you deal with how you go about discussing ways and means in which you can reach your, an agreement between you and your lenders. And now I will hand over to Fred Omondi to take us through the tax considerations.
Thank you, Gladys, and thank you everyone for joining. So I'm sure we are all well. I trust we are all well and we are settling into the new realities. as we look at how to adapt to these current times that nobody would have predicted a few months ago. And definitely, as businesses, we are now grappling with the new situation and trying to find the best way forward in terms of managing our businesses and ensuring that there's continuity, and also taking care of our staff in terms of making sure that they're safe and they're able to continue working from home. Now, taxation is one of those issues that, of course, has become top of mind at this particular time. I guess because most of the time, we are the ones contributing to the government and contributing, obviously, to the economy. And so at this time, we are also, expecting to see something coming back to us, as taxpayers, or to see the government supporting us using the resources that they have. So that has been top of mind of our, our leadership. And indeed, when the president spoke about a week and a half ago, he did outline some measures, including tax measures, to be able to cushion taxpayers and businesses generally from the economic impact of COVID-19. So I'm going to run quickly through some of the key measures that the president outlined. Obviously, some of these measures have not taken effect because they're subject to, the parliamentarians being able to pass the bills that are before Parliament. Although one of it, that is the VAT reduction, has already taken place. So given what we've seen, there is already a bill before Parliament, that's the Tax Laws Amendment Bill, which contains a whole raft of changes to various tax legislation, some which have really nothing to do with mitigating the impact of COVID. So we don't know what exactly the parliamentarians will pass, as they debate this particular bill. But for today's presentation, I'll focus on those measures that were, announced by the president, and expect that the same will be passed when this bill comes into force. So one of the key measures was the reduction of tax rates. So in terms of corporate tax, the president did announce that they'll reduce the tax rate for resident corporations from 30 to 25%. So this is definitely something that's going to be a boost to companies in terms of leaving them with more cash in their hands after tax profits. And this should be applicable from the current year, the year 2020. Of course, there's a debate in terms of what particular period it will impact. But my view is once the law comes into being, if your year ends, let's say in June 2020, then you should be able to benefit from the reduced tax rates. Those whose year has already ended, let's say in December 2019, then you may not be able to benefit for the past year, but definitely for the year 2020, that benefit should come through. And of course, that then means that as a business, you need to review your basis for paying the installment taxes for the current year. As you are all aware, you pay your taxes in advance. So if the rate is going to come down, then it's a good time to review your installment basis. However, what this provision does not deal with is losses, because given what Gladys has presented and what we are all seeing in terms of the trading conditions, obviously many companies are likely to end up in a loss-making position. So, the lower tax rate will not necessarily benefit those businesses which will be heavily impacted, and maybe that will only come in later on when they return to profitability. So the indication we've gotten is that this change will not be just for the COVID period, but it will be, for the long term. So obviously, we'll be able to benefit into the long term. In terms of individuals, there's a reduction of the maximum individual tax rate, again from 30% to 25%. So this should be a relief, especially for those who will be able to retain their income during this particular period. Again, as in the case of companies, there is really no specific measure to cushion those that will lose income. As you may be aware, a number of companies will be laying off employees, or even those in business may not be able to, generate income if their businesses are closed. So again, there's probably need to look at how those can be cushioned, because if you don't have the income, then a lower rate may not necessarily benefit you at this particular time. Again, for individuals, there's a change in the tax bands. So there's a proposal that the minimum taxable monthly income will be 24,000. Currently, it's just under 12,000 shillings. So that is, again, a good measure, especially for the low income earners. And my own view is that this was long overdue, because our tax bands rarely get revised. I think in the last 15 years or so, they've been revised twice. So taking into account inflation and cost of living increment, I think this was long overdue, not just as a mitigation for COVID, but in terms of the bands reflecting the current economic reality. So this is a positive move. For sole proprietors, there's a reduction of turnover tax from 3% to 1%. I say sole proprietors because turnover tax currently does not apply to corporates. So if you're in business as a sole proprietor and your turnover is below 5 million shillings a year, then you are eligible to pay turnover tax. And this has now been reduced to 1%. We've seen in the tax laws amendment bill, there is a proposal to now include corporates within the scope of turnover tax. So if that is done, then if you're a small entity whose turnover is up to 5 million, there's a proposal to move that up to 50 million. Then you'd be able to benefit from a lower turnover tax, which should come in quite handy. The other measure is the VAT, which has been reduced from 16 to 14%. Now that has already taken effect from 1st April, given that the minister had power to revise that rate. So that did not need to await the debate in Parliament, and it should be already implemented by all VAT registered persons. So obviously this should translate into lower cost of products, assuming it can be passed down to the taxpayers and there are no other cost implications in the current situation. But also for businesses, it should be lower cost, especially for those who are not able to take a full credit for their input VAT. So if you get a lower VAT charge, then that should translate into lower costs. So that's also a good move. One of the other things that the president mentioned was that there is that he has directed the Revenue Authority to expedite VAT refunds, of course, to provide a cash flow boost for taxpayers, and he indicated a figure of 10 billion shillings. Now, our discussions with the Revenue Authority, as we are following up, they indicate, yes, they are ready to pay those that have been approved, but they're still waiting for the Parliament to pass the supplementary budget. So those of you who are expecting maybe to see funds in your accounts this week, you may have to wait a few more weeks as the cash flow is sorted out between the Treasury, the National Assembly, and the money is passed over to the KRA. However, that should be still a welcome move. But what our view is that it's not only VAT where we have refunds that have been pending with the Revenue Authority. Many of us will have refunds arising from withholding tax or from other taxes that you have overpaid. And so we think that there should be a focus not just on VAT, but on all tax refunds, and the revenue should be made to expedite this. I mean, this has been a push that has been going on for quite a while. And indeed, there's been a call even for the Revenue Authority to pay interest on those refunds that they do not pay on time. But Treasury has resisted that move. and obviously the funds that they allocate for refunds is not sufficient. So this is likely to be a recurring problem, and I think we still need to maintain the push for them to pay attention to tax refunds, or even allow taxpayers to offset them without a lot of pushback from the Revenue Authority that we currently see. So these are the measures that the President outlined. Obviously, like I mentioned, there'll be more measures that we've seen being proposed under the Tax Laws Amendment Bill. So those will be able to cover at a later date once the bill passes through Parliament, assuming that they adopt all the changes. Of course, there's a pushback that they should only focus on those measures that will mitigate the impact of COVID, and that the others can be introduced at a later date if need be, because they would have quite some, significant ramifications for taxpayers. So we hope that they'll be focused on what is necessary now, and the rest can wait because the timing doesn't appear to be right. Now, besides what the President proposed, looking at what is happening globally, we think that there are certain measures that should be considered, especially in this, especially given the impact of COVID on taxpayers and businesses at large, which is expected to be quite significant. So looking at what is happening, we've borrowed some of the ideas from what other countries are doing, and we think this would be relevant for taxpayers in this country. One of the things is a lot of taxpayers will be struggling because they're not receiving any income if your business is closed. So there is something that other countries are doing, which is to suspend payment of taxes, whether it's payroll tax or even corporate tax, for at least 3 to 6 months to enable taxpayers to conserve their cash and be able to maintain their employees, pay their critical bills. So this is something that should definitely be considered. Of course, it should be subject to certain conditions so that only those who are able to demonstrate that they've suffered revenue loss, or they are not really able to sustain their employees without this kind of support, should be able to benefit from this. But we think it's something that should be considered, especially to encourage companies and businesses to retain employees during this particular difficult period. In our local context, we know that the Revenue Authority has maintained its aggressiveness in terms of tax audits and reviews. So one of the things we think should be relevant is for them to suspend the VAT auto assessments, which is a pain for many taxpayers. So in the current environment, you want to be dealing with keeping your business going rather than addressing reconciliation issues with the Revenue Authority. So we think that is something they should suspend. And indeed, even for audits, they should only focus on very high risk taxpayers where they cannot postpone their audits. But we do think at such a time, it would really be unfortunate for them to be burdening taxpayers with unnecessary tax audits. So this is something we are pushing back with the Revenue Authority, especially because they seem to be operating as if everything is normal. And we've indicated to them in the cases that we are dealing with that we think this is not the right time for audits, and they should give taxpayers some breathing space. In terms of refunds, like I mentioned, other than just VAT, there are many other refunds that are due to taxpayers, and we think those should be approved. Even if they do not have the cash, those should be approved for immediate set-off against outstanding taxes. So if you have withholding tax refund, for example, that you should be able to offset that against your pay as you earn, or even your VAT or other taxes that are due to the Revenue Authority. So this would really help in terms of liquidity for taxpayers. One of the other things we think should be relevant is at this particular time to reduce withholding taxes, because this ends up tying taxpayers' cash flow. So it would be relevant, especially for local companies, since this is an advanced tax, and many companies or many sectors will be affected. Maybe a lot of taxpayers will end up in a loss position. So if you are paying withholding tax in advance, then that means you'll end up in a refund position. So that is a position that we think can be reviewed, even if it's a temporary measure during this particular time. There are a host of other levies that other industries also pay, including catering levy. We know restaurants, for example, are closed now. So some of these levies can also be suspended. We think that would be relevant for quite a number of taxpayers and a number of sectors, you know, the airline industry and, you know, other sectors that have other levies that they pay to the government. In terms of supporting the health initiatives, definitely there should be duty and VAT exemption for medical equipment and other essential supplies that are being you know, imported or that are required for the management of the COVID pandemic. So that is quite relevant, because we know a lot of these supplies may not be available locally. Obviously, there's some effort to try and produce locally, but maybe that may not meet the demand. So if there's importation, then those should qualify for relief during this particular period. Some companies may be forced into retrenchments, unfortunately. And so we think that for those who end up in this unfortunate situation, the employees should probably be exempted from taxation on their terminal dues that would be paid at this particular time, again, to cushion them and ensure they're able to support their livelihood for a longer period of time. There is also a fund that has been set up, and many of us have been encouraged to donate through the to the COVID-19 relief fund. So one of the measures to encourage donations would be to allow a tax deduction for such donations. And of course, this can be specified and can be restricted to avoid abuse. So there could be a set limit or other measures to ensure that it is not abused. The other issue that businesses are grappling with at this particular time is collection of receivables. So this is going to become increasingly difficult, especially if your customers are negatively impacted by the current situation. So we are going to see a surge in bad debts and for the financial sector in non-performing loans. So although there are other measures that you know, other players like the central bank are looking at, but we think that from a tax perspective, the current rules around deductibility of bad debts are very stringent, and this should be reviewed at this time to be able to give some relief to taxpayers, so that you are not paying tax on items that you actually not collected and that are likely to go bad, because the approach that we see with the Revenue Authority now is to insist that you only take a deduction, you know, when a taxpayer has been liquidated or all other measures have been exhausted, which tends to be difficult to prove. So this is something that should definitely be relooked at. Certain sectors which are really significantly impacted may require subsidies from the government. Of course, we know that our government may not have as much leeway as some of the other governments, given the tight fiscal position. But we think that some targeted subsidies would still be relevant in the current environment, at least to help some critical businesses to stay afloat. So that is something that should be considered by the authorities. On an administrative side, there should be room for extension of payment of taxes. So if your taxes are due maybe in June or subsequently, and you are not in a position to pay, they should be more flexible, and especially in terms of waiver of penalties and interests, which we know that is very difficult to get under normal circumstances. But we think the current circumstances call for a lot more flexibility and consideration for taxpayers who face difficulties in terms of being able to meet their tax obligations. Now, working from home has become the new norm for many of us. I'm not sure whether you are enjoying it or whether it's a pain, but definitely it's the new reality. But we think the current setup in terms of a tax law does not really give much recognition to the current arrangement where you have to work from home. So we think there should be something that, I mean, this should be something that can be relooked at, and taxpayers, especially individuals who have to operate from home, or even businesses, certain costs that you incur as a result of operating from home. We think this should be considered and probably granted deductibility. So these are some of the recommendations that we are discussing and presenting to the National Treasury or other government stakeholders for consideration, in addition to what they've already proposed. Coming back to what we think are some of the practical measures that you should consider as a taxpayer or as a business to be able to manage your situation during the current difficult time. One is with regard to VAT. We know that VAT is payable within 20 days after the end of your VAT reporting period. So, for example, if you are reporting for the month of March and you want to manage your VAT liability, then as much as possible you should avoid billing towards the end of the month, because that means that VAT will become due within a very short time. So you should be able to look at your timing in terms of your billings, especially the significant amounts, or those that you can maybe project their collection, so that you time your billing to come, either earlier on during the month to give you a lot more time to collect and pay the VAT, or where you are able to predict when your customer will pay, then you make the billing just before the payment is due, and that will help you to manage your cash flow. From a withholding tax perspective, we know that following a High Court ruling, withholding tax is now due on accruals. And so one of the things as a business is to relook at your accruals policy and maybe delay some of the accruals that are not maybe mandatory until such a time when it's really unavoidable, because once you accrue and the revenue gets sight of it, then they'll demand the withholding tax. Also, to manage your withholding tax, you should really relook at your accruals. From an installment tax perspective, this is the time to adopt the current year basis, especially if you expect that your results will be negatively impacted. So rather than pay and end up in an overpayment, it would be good to estimate your trading results for the current period and change your installment tax basis to current year basis. A lot of taxpayers are going to be relying on debt, and there may be some who already have loan arrangements, either with related parties or other parties. So especially in the case of related party loans, this is the time to review some of the loan covenants and determine whether they still need to attract interest, because even if you are not paying the interest, like I've mentioned, the withholding tax will fall due. So if there's a possibility for either suspension of the interest or waiver of the interest or deferral, these are some of the ideas that you can discuss with your related parties and restructure those loan arrangements so that you mitigate the cash impact in terms of tax outflow by looking at some of the loan covenants. So it may also require that some of the loan could be converted into equity, especially to manage your debt to equity ratio. That has an impact on the tax deductibility of interest. So again, if you are impacted, this is the time to review those loan arrangements and see how those can be restructured. If you have credits arising from withholding tax, withholding VAT rather, the law now allows you to use that to offset against other tax liabilities, of course, subject to application to the Revenue Authority. So this is the time to push for that and try and utilize some of your overpayments or withholding VAT. Again, for those dealing with related parties, this is the time to review your transfer pricing policy. Some of the policies may call for a fixed return or a certain level of return, which may not be appropriate under the current trading conditions. There could be intercompany services that are being provided. This is the time to review what is the basis for charging those. Can there be a reduction in some of those charges where appropriate, or how do you see those arrangements working at this particular time? So rather than wait for the end of the year and then get surprised by the results, this is the time to actually sit down and have a discussion and review your transfer pricing arrangements to make sure that they're appropriate for your current trading or economic environment. If you are not able to file your return on time, obviously the law provides for you to apply for extension of time to file your returns. So this should be something that you can easily take advantage of if you consider that you may not be able to do that on time. Of course, like we mentioned, the more appropriate one would be even a possibility of extension of the deadline to pay your taxes, or waiver of any penalties and interest that may accrue for non-compliance. Again, I mentioned earlier that bad debts are likely to rise. So this is the time to have your documentation right in terms of being able to support the deductibility of any bad debts, because these face a lot of scrutiny from the Revenue Authority. So you need to make sure that you have the right documents in place so that can support you for those debts that you consider you will not be able to collect. And then that can help to sustain an argument for deductibility. In case you're facing financial difficulties, we know that although this is rarely used, but we know that you can apply for a payment plan with the Revenue Authority. And typically, they should be able to consider that if you are facing severe financial hardship. Although, of course, that doesn't deal with the penalties and interest, but then one could always apply for waiver of those. So in case you are stuck, you should be able to approach the Revenue Authority and enter into a payment plan, whether it's tax arising from your normal self-declaration or from a tax audit. There's a possibility that you could enter into a payment plan with the Revenue Authority. For those who are liable to pay excise duty, especially manufacturers, again, this is the time to really manage your stock and production so that you don't end up with a huge excise duty bill. So the timing of your production and stock management in light of changes in demand, I think this is going to be critical so that you don't pay more excise duty than would be necessary, whereas maybe your stock is not moving as fast as it would be under ordinary circumstances. And for the smaller taxpayers, those who are subject to turnover tax, there is the option to consider whether to pay turnover tax or to elect to be taxable under the normal corporate tax rules. So this would be relevant, especially if you consider that you may end up in a loss position because the turnover tax does not take into account your expenses. So it would be important for one to consider whether they want to elect to be taxable under the normal rules. So these are some of the measures that we think as a business are very practical that you can take into account. Of course, the list is not exhaustive, and during the discussion, we'll be able to relook at some of the other proposals that you may have in mind, or some of the other questions that you may have that could be of help to taxpayers at this particular time. So I'll pause there and allow my colleague Gladys to come in and take us through some practical measures for liquidity management. And then we'll come to the question and answer session after Gladys has finished. Back to you, Gladys.
Thank you, Fred. We've all heard what's available to us from a tax perspective, and now let's look at what other measures then are available for us to be able to manage cash during this time. So we've moved from a perspective of where businesses are looking at the profit and loss, and now looking at cash. And basically, what we used to use for cash management in the past will not be able to sustain us during this time. This is a time where you decentralize all cash operations, where you are in a position to only have the CEO and the CFO make the cash decisions that need to be made. You need to come up with weekly cash forecasts to make sure that you are able to see what is coming in and what needs to be paid. And this needs to be then updated on a weekly or even on a daily basis as receipts come in. So it's very important that governance of cash becomes very critical at this time, and you appoint someone who is basically the gatekeeper of how you spend what comes in. So controls over cash are very critical during this time. And this is the time when, if you have payments to make, you need to match this to receipts. And you're not going to pay somebody because a client has promised to pay you next week or tomorrow. So it's a time where you match actual payments to receipts. You speak with your debtors and offer them probably early payment discounts to just get the cash in. And then that means you need to update your accounts receivables on a daily basis. If it is possible for you to look at your revenue forecast on a weekly or a daily basis, this needs to be implemented as well. The other avenue you can look at is talking to your key customers or your suppliers to see how you can leverage on this relationship, given that you have a good past history on how you can stagger some of the payments to enable you to preserve the cash that you have. This is a time where you eliminate all discretionary spend. You only spend that which is absolutely necessary. So you suspend all programs that are not going to generate cash in the near term. And then you need to look at what payments are business critical. What do I need to pay? And then you schedule those and you pay them when they arise. So in a situation where you are probably paying your rent quarterly in advance, you go back to the landlord and you renegotiate how you're going to pay. Do you pay then, monthly in arrears, or what kind of payment plan do you want? Because what is very critical is you need to respond to the current crisis we are in so that you're then able to recover after the pandemic is over. And then after that, your business can then be able to thrive and be able to take advantage of the future. So if you don't preserve your cash now, you are you face the risk of not being able to recover when the time comes. And then the other thing is looking to turn your fixed costs into variable costs. So how do I deal with some large lease payments that I have to do? If my plant is not operating at 100%, what costs can I save to make sure that they then match the production volumes that I'm able to, to be able to produce at this time? And then COVID-19 has created a lot of disruption in the way we do business. So if you're a business that can take advantage of alternate delivery models, using online platforms to make your sales, then this is the time to take advantage of this to ensure that you preserve some of your sales and are able to have some business going at this time. On employees, so Fred has talked about the measures that the government is putting into place to basically cushion your employees during this time. So you need to freeze your new hires. If it's not a mission critical position, you cannot be recruiting at this time because you do need to preserve your cash. And then find out how you can deal with your temporary employees and your contractors where contracts are coming to an end. You need to deal with that right away, because it is important that you save every penny that you can. There's a bill going, that's due for debate in Parliament around, unpaid leave. How do you negotiate with your employees on flexi working hours where maybe you're not paying them at 100%. So you need to think about how you're going to reduce your employment costs during this time. This is not the time to spend on capital expenditure. So you only do what is necessary, like maintenance capex that's required to ensure that the business is running during this time. You need to look at your levels of financing. Do you have any reserve cash flows that you can draw from during this time? And where you can draw then from these cash flows, you also have to be very careful about what you're using these cash flows for. You need to engage all your stakeholders during this time, even your lenders. And you need to make sure that you don't maximize your credit line such that when it comes to the point where the business needs to recover and business is now picking up, you don't find yourself in a position where you have spent all the cash to survive during this crisis, to the extent that you're not able to draw up on new lines of credit when you actually need them to start maximum production or to invest to get your business back to scale. So on the government incentives, Fred has outlined what's out there. So just make sure you maximize the government incentives to the full during this time. Some businesses have non-operating assets. So you need to find a way and ask yourself, is there a way we can, look to sell this and, assets that are probably not encumbered? How do I engage with my financial creditors during this time to see how I can maximize on these assets during this time? Are there avenues to negotiate, say, with pension fund trustees during this time to see how you can defer some of the payments to be able to meet your mission critical cash needs during this time? So when we look at liquidity, you're looking at how do I maximize the recovery of my receivables? How do I manage my inventory from the perspective of how do I ensure that I get in inventory when I need it, to enable me continue with production and realize my revenues? And then from a payables perspective, how can I negotiate with my creditors to ensure that I only pay those expenses that are business critical and when they are due, to ensure that there's business continuity? So it's very critical that we respond appropriately during this time, so that when the pandemic is over, we can then move into recovery mode and be able to thrive. Because if we don't survive from a cash management position during this time, it will become very difficult for the business to be sustainable in the future. So thank you very much. I think we can now move to our Q&A session.
All right, thank you very much, Fred and Gladys. I think that was really, really insightful. Now, time is not on our side at all. We have about 11 minutes to take as many questions as we can. And so what I'll do is we have several questions coming into the Q&A box. For us to save time, what I'll do is that I'll hand over this real quick to Fred, instead of me asking the questions and the speakers answering. We've already been in the background just sampling a few questions that I want to just quickly hand over to Fred to just take a round of questions, and then we can come back. If there are some that are specific to Gladys's presentation, then that can be done as well, just so that we move quickly. So Fred, over to you.
Thanks, Maxwell. I'll read through a few of the questions and answer them. Where we are not able to answer them now, we'll be able to send the answers even after this particular session. So one of the key ones, which I think is relevant to many of us, is that for employees, or rather for salaries which are due to be paid this month, a lot of you are wondering whether to apply the 25% or the 30%. Now, unfortunately, whatever the president read was not law. It was his proposal or directive, and these have to be translated into the law. So the bill is still before Parliament. They were supposed to debate it. We had hoped they could pass it this week, but it appears they pushed that to next week. So if you have to process your payroll before the bill is assented to, then you would have to apply the current rates, which is 30%. And then once the bill comes into law, luckily income tax applies for one particular year, not necessarily for a month. Even pay as you earn, although you deduct it on a monthly basis, but the tax on the individual is for a year of income. So you will be able to adjust in the subsequent months. So that is our proposal, that you can apply the current rate and then later on look at the annual income and adjust before the year ends, either in the subsequent month or as you go through the calendar year. So it still gives you room to be able to change the rate, but for the current month until the bill is passed, you have to then use the current rates. Now, looking at some of the other questions, again, issue of whether the new tax rates are effective April. That was the proposal, but again, until the bill is passed, remember there's a question as to whether the bill can be, rather the law can be retrospective. So that has been argued before, sometimes in favor of the taxpayer. So even in this case, the position would be that we wait for the bill to become law. The only measure that has taken effect is the VAT, because under the VAT Act, the minister had the power to vary the VAT rate. So that is already law, but the others await the passage and assent of the bill that is before Parliament. There's a question in terms of clarifying the position on the proposed changes to withholding tax on existing infrastructure bonds. So again, there's a proposal to remove the exemption from tax of the interest that is paid on infrastructure bonds. So if that passes, then it means any interest that is paid after the date of the change in legislation will not be exempt from tax. So definitely that will negatively impact the infrastructure bonds and reduce the return that the investors have been getting from the infrastructure bonds. So that is something that will be negative probably. Someone asked whether withholding tax is due on accruals and whether this applies to withholding VAT. No, because those are two different taxes. Withholding VAT is really where your customers withhold a portion of the VAT when they are paying you for your invoices that are subject to VAT. And in the case of withholding VAT, it's only applicable where one is a withholding VAT agent. So not everyone is a withholding VAT agent, and that should be taken into account. Someone has asked for an opinion on our Senator's draft pandemic response and management bill, which has proposed a number of measures like exempting Kenyans from paying rent, or barring employers from laying off, or exempting SMEs from paying trade licenses and land rates. So, I mean, this is something that is, I guess, still open to debate. Some of the measures may be one-sided, and therefore there's, of course, a need to balance those against the interest of the other side, whether it's the landlords, how do you cushion them if they're not getting paid for the rent? What are the arrangements that maybe the government can put in place to be able to cushion them? So that has to be balanced between the two parties. In terms of employers vis-a-vis employees, again, what we are seeing is the government has not really put in place specific measures to be able to maybe support employers who may not be able to pay their employees. So that has to be balanced with that requirement that there should be no layoff. However, we note that, of course, they provided for an unpaid leave, which could be an option that employers could consider. But there are other measures such as renegotiating your terms with your employees, of course, subject to the current labor laws, which the lawyers would be in a better position to comment on. So that has to be done based on agreement with the employees, and those are discussions that you can start having even as you look at all your options to be able to mitigate the impact of COVID. Any possibility of extending tax filing deadline? Now, the good thing is this is already within the law. You are actually allowed to apply for extension of the time to file your return, but you need to do that with, at least 30 days before your tax return deadline. So if you anticipate you are not going to be able to meet the deadline, please apply to the Revenue Authority and ask for an extended, for an extension of the deadline. Someone has asked, how will the government take care of the gap in the revenue now that the tax band has been reduced? So good question. This is probably why a number of other measures have been sneaked in, if I may use that term, into the tax laws amendment bill. So you realize that the changes are actually much, much more than what the president recommended. So the other changes are really to claw back or to take back some of the tax incentives and also to impose VAT on some commodities that were exempt or even zero rated. So the Treasury is hoping that with some of those measures, they can be able to get some additional revenue to cover for the gap that has been caused by the reduction in tax rates. But given the current economic situation, we do expect that it would be unrealistic for the government to realize its tax collection targets. So then they have to go into other measures like managing the expenditure, and that will be more critical as we go in, even into the new year, the new government financial year, because if they don't do that, then we are likely to end up with a wider deficit, and you know, the borrowings are likely to increase beyond the current level, which is already being seen as likely to be unsustainable. So because of time, I'm conscious of time. I think, Maxwell, I'll hand back to you for conclusion. Okay. However, we'll be able to respond to all the questions. We've taken note of them, and we'll be able to prepare the responses and communicate those to you. Additionally, we'll share our alert on the tax measures that are being considered by Parliament, and you can be able to look at that. And when those are finally passed, we'll also be able to share with you whatever changes come through. So thank you very much for your attention. Back to you, Maxwell.
All right, thank you very much, Fred and Gladys. Fred, I think before we let you go, there's two questions here that I think we have 2 minutes to see if we can cover. I think the first one is, you know, there's been quite a bit of criticism from different quarters that the measures that have been announced by government and as president in this particular case may not have much impact. And despite the parliamentary budget office giving an estimate of, I think, revenue loss of about 122 billion from these measures. What from your vantage point is your view? Do you think government has done enough to really support and help businesses stay afloat during this period? And individuals, of course, cushion the impact of this to individuals. What is your view on that? And then that's one. And then for you, Gladys, an aspect that keeps coming up is, you know, and this is now, I think, a buzzword, scenario planning. And I know you talked about, you know, how to manage your cash flows and so on. I think for business leaders, the key thing here would be, you know, what are some practical steps that can be taken towards that? And what sort of time horizon do you work with anyway? Because this situation is evolving practically every week. So how do you approach that as a business leader? And how do you make sure that you know, you're making the right strategic decisions at the right time? So just real quick. And finally, Fred, just one more for you relating to the tax laws amendment bill. We realize that some of the you know, bread, milk, some of the basics, the staples have been, you know, zero rated, yeah? No, have actually become exempt as opposed to being zero rated, yeah? Which means that then the input become costs to producers. Aren't we then just, you know, sort of shooting ourselves in the foot? Because it's almost inevitable that the prices of those basic commodities will then go up. And in this period of time, during this crisis, is that really a good move in your view? So just those 2 or 3 questions real quick, and then we can close.
Thanks, Maxwell. I'll start with the last one, which is, I mean, which is quite top of mind for many taxpayers or for the wananchi. Now, I think what the government has done, and this could be the Treasury leading the initiative, is to try and look for ways to recover some of the tax that could be lost from the incentives that have been provided. However, the timing is completely inappropriate, because now we are saying, you know, businesses and the taxpayers are at their lowest moment, given the impact of COVID-19 that none of us anticipated. So it is the wrong time to come and, you know, put in place measures that would actually result in an increase in the cost of living. So we think the Treasury was being cheeky there by, you know, sneaking in measures which we know have been under consideration. These are not new, by the way, because when the VAT Act 2013 was put in place, there was the theme was to actually remove a lot of the exemptions and the zero rating. But then what happened, subsequent years, they reversed and introduced a lot more exemptions and zero ratings, and we went back to where we were before. So from a policy perspective, we know this is what has been intended. However, the timing is completely inappropriate, and we would recommend that these measures be put on hold until such a time when you know, the economy is back on its foot. We know also this push has been coming from some of our external donors, or the likes of the IMF, who've been you know, engaging with the government and saying that in our current regime there are too many exemptions and these should be relooked at. So I know there's been that push that the Treasury has been feeling, and it's really an issue of timing. And then some of these need a lot more debate so that we are sure on what is the priority, you know, from an investment perspective, from a sectoral perspective, what are the priorities, so that we don't put in place certain measures and then after 1 year or so, we start reversing the same measures, because that's what has been happening. We change the law and then, you know, after 1 or so years, we have to reverse it because of the impact. So I think it needs a lot more robust debate to be able to determine what exactly is the priority, and then we can make the law to be a bit more stable as opposed to the current situation where we are seeing a lot of frequent changes. On the second question, or your first question, as to whether the government has done enough, looking at what is happening globally, definitely the government could do more. But remember, this is almost related to the cash flow issue that you know, Gladys has been talking about. So the government is working within a particular resource pot, and all of us know that given our current debt situation, our budget deficit, you know, our government has been starting not in a very good position. In fact, even without COVID, we were not expecting that they were going to meet their revenue collection target. So given that in mind, I'm not really surprised that they haven't done maybe what other governments have done in terms of being able to actually, you know, offer subsidies or certain other, you know, measures to actually improve liquidity for businesses, or to put money in the pockets of the wananchi. So I'm not necessarily surprised. However, there's definitely room for them to consider such measures. And this will call for a number of bold measures, especially being able to relook at our government, our national budget, and try and repurpose some of that expenditure, try and see where we can cut the unnecessary expenditure. Obviously, the president has tried to touch on some of that when he said that they'll redirect the expenditure they would have incurred on travel to try and manage the COVID. But we think there are many other areas of expenditure that need to be relooked at, so that if the government can come up with a particular package that will put money in the hands of taxpayers, or even extend support to businesses, I think that would be much more appreciated, because the current measures are more favorable, if you ask me, to those who are already, to those who are not significantly impacted, you know, those who are able to retain their income or to retain their business. They'll be benefiting from the current measures. But those who lose their income or their business is severely impacted, I think they've been left, you know, hanging, and there's more that needs to be done. So that's my take, Maxwell. Gladys, over to you.
Okay, thank you, Fred, and thank you, Maxwell, for that question. So basically, we are in a situation we've never been in before. So you don't know what the impact on the business will be, next week, next month, or even at the end of the year. So what the best thing you can do is then to look at your business. So you've looked at the macro, you've seen what the impact is on the various industries. Then you now come closer home to your business. How has your business been impacted? How has the industry been impacted? And every business leader will know their business best. If you're in the financial services industry, you know what the issues are. If you are in, hotel and tourism, you understand how you've been hit. So when you look at all these aspects and how it has hit you, because given that we are about a month and a few days since our first case was reported, some people had started feeling the pain even before that because of global supply chain issues. So it's looking at the reality of your business now, looking at your book of business in terms of your ability to generate revenue and how much of that revenue can really come in. So you start then with a 13-week plan to start with. So you have your 13-week cash flow where you look at what is coming in, what do I need to pay, and what resources do I have, what lines of credit do I have, and how do they help me during this time. So you start with that. Then you ask yourself, but what if this pandemic lasts longer than I expect? So where will I be, say, in the next 6 months? What if in the next 6 months my business is still struggling? What happens then? Or what if then the impact is there until the end of the year and beyond? So what does this mean for my business? So it's taking steps to look at the scenarios from current state in terms of this is the best case, and then looking again and saying, but what if this continues and I probably get to a situation where my current revenues are affected by another 30%? And what if after that I'm affected, the 30%, the 70% that was left then is reduced maybe by another 50%. So it's modeling this in a spreadsheet, which is not easy given the reality is changing every day. We don't know what will happen next week, but you need to start at least with your 13 weeks forecast, and then look at it from the perspective of this is where I am, these are the realities. Come another 3-4 months, if this is going to continue, how much revenue am I going to lose? And then how do I need to start adjusting and communicating with the various suppliers and critical people that I have to deal with to be able to survive this? And then what is available for me? And then also looking at your industry, what is the length of recovery it's going to take? Because what's going to happen is that it's not going to be like today you say it's over and tomorrow it's business as usual. So business leaders have to be realistic that the impact on your business could be, it could take 6 to 18 months before you get back to your normal business operations. And so you do need to model this, the various scenarios. What if this happens? What if that happens? So you have a best case, or then you have your normal case, and then you have then what would be considered a worst case scenario where the pandemic has, a more ravaging impact on your business.
All right, fantastic. Gladys, Fred, and the rest of the team from Deloitte, thank you so much for your partnership on this webinar. I think the insights have been great. We've come to the end of our webinar. We will share the presentation or the presentations that were made this morning to the various participants who are on call. And I really want to just thank everybody for turning out in such huge numbers. We had 209 participants on this call or on this webinar, which is fantastic. I really pray and hope that you take care of yourselves, and thanks once again for participating on this webinar. Thank you. Bye-bye.